Hello, everyone, and welcome to the Buck Stops here. I am Catherine Murray. Well, as you may have seen, the markets have been on a tear to the upside, weakening a little bit over the past couple of days. But importantly, as we look at the first quarter and the great performance we've had, where do we go from here? And what are the key drivers that we really need to continue to be thinking about and monitoring? For that, I wanted to bring in a veteran investor, that is, of course, Barry Allan. He's the CEO of DMAT Capital. Barry, great to have you on the program with us again and to get your perspectives. You have been in the business a long time, and I think that perspective always helps our viewers. So thank you.
Great to see you, Catherine.
Thank you. So Barry, as I mentioned, look, the markets have been on a tear. If we all recall, there were many very great strategies last year calling for a recession. The key driver, of course, I think that we continue to look at is what the central banks are doing, and they're looking at inflation, and that seems to be your key focus as well. How and why is that so important?
Well, I do think that the direction of financial markets and the economy, and they're not necessarily going to move together, is tied to the direction for inflation. And inflation is driven, when has been for the last 60, 70 years, by wages and oil. I don't think that has
Hmm.
changed. And so we're at a different point now where we had, for the last 60 or 70 years, inflation has driven financial markets. But we had a 20-year period where no matter what the central banks did, they really couldn't create inflation. And the pandemic has proven to change that. And I think that there's a couple of very fundamental reasons why the pandemic changed the outlook for inflation.
But going back to what you just said, in terms of who's driving inflation and the connection with the pandemic, describe that a little bit more.
Well, we spent a lot of time analyzing what was different with the economy after the pandemic versus the 20 years prior to it. And the economies actually look pretty similar with two major exceptions. And those exceptions were the pandemic created excess savings that sustained the economy after the things significantly and contributed to growth, because as soon as the pandemic happened, the central banks printed a huge amount of money. They gave it to the government. The government gave it to consumers because they couldn't go to work and earn money. And also, people work from home. And when you work from home, you don't have to buy lunch. You don't go to drinks with your friends afterwards. You don't have to drive to work or take the train to work. You don't buy suits and ties and new clothes and everything. So the savings rates went way up during COVID, and that created a pool of capital to sustain the economy significantly thereafter. Now,
Hmm.
all of those excess savings are now gone, but
Right.
it created to economic growth after the pandemic significantly. The other
And
thing that
yeah.
really changed was the labor force participation rate. The US lost about 1.6 to 1.8% of the labor force during pandemic. Either they succumbed to COVID, baby boomers retired because the stock market was up a lot. Women often left the labor force to look after either parents or children. Um, so we lost, maybe 6 million people from the US labor force. And
Hmm.
that has changed the dynamics of wages and labor significantly. And that isn't going to go away. It may take 10 to 20 years for the labor force to be rebuilt, which is going to keep wages higher than they otherwise would have been if we didn't have the pandemic.
Understood. Um, And it's interesting and it's important to review the impact and the effects of the pandemic, because I think obviously so many people want to put that behind us. But I think to your point, they are having longer lasting effects on the outlook for inflation. So we'll pick that up on the other side of the break. We'll be right back.